morning. It is Saturday, November 12th, and we are here for another happy hour, the Rent Race 2022 Home Buyer Series that we do. I'm Janell McIlwain. I'm the team lead of the McIlwain Group at Samson Properties. We have ESO, our client care specialist, our backbone. We have Tia Thompson. She's one of our Realtor partners. We have Don Morning. And we have our great James Adamson. He's going to be our featured lender today. As you all know, that we try every month to bring you some great information about what's going on in the market. And we're going to start off talking about the role and importance of the agent. We're going to talk a little about interest rates. As everyone knows, the interest rates are rising, and we want to know what does that mean for buyers, and also what does that mean for sellers, because although interest rates have risen, it doesn't mean that you still can't be competitive in this real estate market. We're going to talk about some of the loan programs you have and some of the pros and cons. I believe our last series talked about how, some people are jumping into the first-time home buyer programs. Some people, or they're jumping into other programs, not really analyzing the cost benefit of if you have the ability to not have to go into one of the programs when it deals with your interest rates. We're going to talk about the state of the housing market. And, is my house still out there? And the answer is yes. Additionally, we're talking about finding the right lender, the pre-approval process, and moving forward with our best loans. So what we're going to do, as you know, we keep it an hour. It is our home buyer happy hour. I do have my tea, and you all choose whatever your drink of choice is. But we're going to start with Dawn Ferguson, and she's going to talk about the role of the real estate agent. Thank you, Dawn.
Okay, good. Thank you, Janelle. Good morning. Good morning. So the role of the real estate agent, it is very important to have an agent to go through this process with you. It's great to look on Zillow. It's great to look on Redfin and all these little sites to see homes. But there's one very important thing. The real estate agent is going to help you manage purchasing your home. For one, it takes a professional to even understand if the home that you're looking for, if it's priced correctly. Just because that home is listed for $300,000 does not mean that that is the correct price for that home. The real estate agent is going to guide you. Also, if you do find a home that is priced right and you make an offer, we're going to suggest an inspection. And even getting to that part, you need someone to get you through the legal paperwork. There is a ton of paperwork that has to be done to get you to the point of being able to make an offer, to be able to purchase the home and be happy with your home. So what we typically do when someone is interested in purchasing, we set up a buyer's consultation where we sit down with you and we go through step by step what it's going to take to purchase this home. A lot of people want to just kind of step out there. I can afford $300,000. Let me just go out and look at $300,000 homes. Well, you need to talk to a lender. You need a lender to tell you what you can, a lender to approve you for an amount, and then decide, just because you're approved for that amount, is that monthly payment going to be doable? Is that monthly payment still going to allow you to save money towards other things you want to do? Is that monthly payment? So you may, even though you're approved at a certain amount, you may decide, I want to go $500 less. We're going to help you with that. Did you want to add something? Oh, no. So we're going to help you manage and get through. The average person is not going to know every step you need to take to home ownership. Even as far as choosing a lender, I actually yesterday met with someone who said, I called my bank, I have a letter. My first question is, are you getting any money? Mm-hmm. So your bank that you're using, are they offering any programs, or are they saying, hey, you need 20% down, this is it, this is what you need? So the average person is not going to know that there are options, that there is money out there, that there are lenders who can help you with that. So it is very important to have an agent to help walk you through the steps. And the beauty of it is, on the buyer side, You don't, I think people think it's expensive or you're paying the agent a large amount to help you. The majority of what's paid, other than a broker fee, which is minimal, it's paid by the seller, not by the buyer. So it really costs you nothing to have an agent help you through this process. T and Janelle, did you all want to add anything to that?
What I do want you to do is to go into a little bit further about the exclusive buyer agency agreement. Because
okay.
what happens is we find that buyers get a little skeptical when we ask them about the exclusive buyer agency agreement. And
So
the one thing that I definitely want to touch on that in right there, if you can just talk a little bit more about that.
Okay, absolutely. So what happens when the exclusive buyer basically just says that we represent you? So when we walk into a property, I am working for you. I'm not working for anyone else. I'm not working for the seller. I am working for you. Now, the importance of that is if I don't have that agreement signed when we walk into a property, I represent the seller. Essentially, you're unrepresented. So, and people get really nervous about signing this agreement, but it spells out exactly what my duties are. It's spelling out what my compensation is. It is protecting you, actually. So you're not walking in the blind. So, and the beauty of signing an agreement, we give you, say for instance, you know, it doesn't happen very often, but say for instance, the relationship does not work and you decide, you know, I'm not going to purchase a house right now, or you decide that you don't want to work with me. You know, that rare thing does happen. So, but we give you an easy out in writing. And it's written down in the agreement if you decide that this relationship's not working, or hey, I can decide, you know, I have decided that this is not working. So you know what, in writing, you can say, you know, Dawn, I'm not going to do this right now, or I'm going to choose to use someone else, or whatever it is. Send me an email. And the agreement's ended. So people are skeptical a lot of times about signing this agreement because you think you're stuck for 6 months, for 4 months. But the beauty of it is that time that we're in that agreement, I am working solely for you in your purchase of the home. I'm not representing the seller. So if I walk in to a home and we see something obvious, I'm not a home inspector, but if I see mold in the corner, I'm working for you. Hey, there's mold in that corner. If I don't have that agreement, I work for the seller, and that mold is none of your business.
And I want to say the great thing about when we talk about the exclusive buyer agency agreement, it's like, you know the analogy I always use. Okay, everybody is in a car, you're not doing something, you get pulled over, everybody gets locked up. Okay, so you have the public defender and you have the public defender, you have your attorney. Okay, so when we don't have the exclusive buyer agency agreement, it's like going to the prosecutor and say, hey, will you represent me in this case, when you all know that they're representing the state. And so basically what it is that, like you said before, we work for the buyer that we're representing, and we have fiduciary responsibilities to make sure that we represent them correctly. And like I always tell people, I'm the Debbie Downer when we come to a property. I'm the one looking at structural issues. I'm looking at foundation issues. I'm looking about water penetration, things of that nature. Whereas if we don't have that buyer agency agreement, those are things that I don't have to look at.
And I will also add, when we talk about the role of the realtor, I think a lot of potential buyers and or sellers think that we're just really focused on the resale portion of real estate, basically previous ownership, home ownership, where we have someone who's owned the home before. But we're also, it's also good to have a realtor when you think about new construction, because things do happen even with a brand new house. And I can tell you firsthand that I recently, just in the last like 2 weeks or so, had a client that bought a new home, brand new home, went through the walkthrough, and come to find out there was like 4 or 5 outlets that weren't even working in the home. And so this is a brand spanking brand new home that supposedly passed, inspection before they called before they had the buyer come in to do the walkthrough. So those kind of things do happen. You know what? The new homeowner probably would have never checked the outlets because it's in their mind, they're getting something that's brand new. But those things, your realtor is thinking ahead to make sure that you understand what you're getting into, and to make sure that you are also protected, even in new construction. Dawn mentioned home inspections. You know, we recommend having a home inspector come through for your home inspection. I'm sorry, a home inspector for your new construction.
Oh,
My coffee kicked in. I've had 2 cups already. So again, that home inspector really is there to help you find, you know, those things that even your realtor may be seeing. So again, it's always good to work with a realtor. Like Dawn said, we help you through that process of the complicated paperwork, because it can be complicated. We're your advocate. Like Dawn said, I mean, I'm sorry, like Janell said, you know, we're looking at the homes to make sure there's no structural issues so that you can make a determination whether you want to proceed, you know, with that property or not. So if you have a realtor, great. If you feel like that's something that you need to invest in, you know what, reach out to our team. We'll be more than happy to help you.
And I want to touch one more thing on the home inspection, which is very important, is that the home inspector actually takes you through the home and shows you the furnace, what size filters you need, how often you need to change the filter. They show you the main water valve to cut the water off in the event of a water emergency. It's good for prior homeowners and it's good for new homeowners, because the new homeowner, they're not thinking that something could happen where water's gushing and they need to know how to turn that water off. So, or even changing the filters. If no one's told them, even someone can have a home and have never changed the filters or changed the filter only when there's a problem. They don't understand you're supposed to change those filters. You're supposed to change the smoke detectors. They're making sure the smoke detectors are working. So very important for the home inspection. And like Tia, I've had a new home construction home inspection, and there was a crack going down the inside of the garage. Now it ended up being a hairline crack that was not a big deal, but I'm purchasing a new home. I'm spending $500,000-$600,000. That crack needs to be fixed before I go to settlement.
Yes.
So,
And then, as we said before, we will have a buyer consultation with you as a buyer. We do it virtually, we do it in person. Your choice is kind of yours. The great thing about the buyer consultation is that what we try to do is prepare you for what you're about to go through. You know, buying a home can be stressful, and it's better to have some idea about what the process is before we go into it, in comparison to being in the middle of it and then you have all these questions. And this is what our buyer, and we actually, you know, we have a digital form that we can send to you where we'll break down the process so you know step by step of what you'll be going through. Now, there's going to be some stressful points. I'm not going to, you know, just buying a house is stressful, period. There's going to be a lot of documentation you need to prepare. And that's the reason why we have one of our lender partners here. We have several lender partners that just don't do home inspectors. I mean, just don't do lending, but we have some that do home inspections. So the great thing about our team is that we do have several lender resources that we can provide for you for the different things that you may have to go through during the home buying process. We want to make sure we manage your expectations, and that's where the lender comes in also, because I mean, it's just not about how much you're approved for. It's about, as Dawn said before, do you feel comfortable with the price of what you're going to have to pay? And if you got pre-approved a few months ago, you definitely want to get pre-approved again now, because the interest rates have gone up. So what does that mean? It means that you may not be able to purchase as much as you wanted to, but you date the house, not the rate, because as we know, the rates will be changing. So without further ado, we want to get with our lender, who's James Anderson with Ameris Bank. He's going to give us a breakdown and tell us of some of the new programs. I know there's a lot of new, since the interest rates have gone up, but there's a lot of different programs that have come out from different lenders. He also has a great program that's like a stackable program. And we're just going to learn a little more about that. So James, thank you.
Thanks. I appreciate you inviting me in to go over all this information. Let's start with rates. That seems to be on everybody's mind right now. Interest rates have gone up about 2.5% to 3% since January, which is a pretty big jump for 1 year. It's the highest I've ever seen in my 30 plus years of doing it. Now, that being said, if you were to average rates since I've been in the market, that would probably be around 6%. or in the 6% range. So where rates are right now is not abnormal. If you talk to your grandparents in the 80s, their rate was 12, 15%. So unfortunately, after 2008, the feds were trying to stimulate the market. So they said, we're going to buy billions and billions of dollars of mortgage-backed securities. And lo and behold, the rates dropped into the 2 to 3% range. And it held, and that continued to go on for a long period of time. So there's a group of borrowers out there that think that those are normal rates, that, you know, that's what interest rates normally are. But that's not the case. The feds were making it that way. And in December of last year, they stopped purchasing mortgage-backed securities. And you immediately saw the market start to, or the interest rates start to climb up. And they've been climbing since. Now, I would say the last month we've had kind of a lull. They haven't gone up too much and they haven't gone down too much. And in fact, there was a rally of the bond market Saturday, which improved rates some also. So most economists think that second quarter of next year, we're going to see a dip in interest rates. But by the look of that mortgage bond market, I think we're going to start seeing those rates maybe at least start to level out and maybe start to go down a little bit. But the best way to look at a market is it's like a seesaw. So for the past 2 years, on one side of the seesaw, it was a seller's market. On the opposite side of the seesaw was a buyer's market. When it's a seller's market, you're not going to get seller help. You're going to pay top dollar for the house. You're competing with a lot of people and trying to purchase a house. In some cases, borrowers went above the sales price. So even though with the rates going up, now's a good time to purchase because that seesaw is starting to tilt over towards the buyer side of the market. So we're seeing the sellers pay seller help again. We're seeing the values start to come down some. In California, values have dropped 25%. In most of the United States, that drop has been between 5% to 15% in values. So the question being, is it a good time to purchase a house? That would be yes. You can always refinance out of these rates when the market turns. But the key factor is what, you know, am I getting a good deal on the house and can I get some help to get there? So as far as interest rates go, they have gone up, they've leveled out. Most economists think we'll start to see them dip back down again into the lower range second quarter of next year, maybe a slow decline that could start next month. The main thing is that those interest rates again are at the norm. This is on average. If you were to average interest rates over, you know, the long period of time, it's actually been in six range. I don't think we'll see 2% again. I think we might see high threes possibly, but it's possible to get back to the fours and the fives. That's my opinion. Now, as far as in regards to the interest rates are going to vary from program to program. So on FHA, usually the interest rates can be lower than what the conventional rates are. You know, just like sometimes slightly lower. And that includes FHA, VA, and USDA tend to have slightly lower rates than conventional does. The thing with FHA though is you have that high mortgage insurance premium payment, where conventionals is lower. So, you know, when shopping rates, you always need to know what program you're looking at, where your credit score is, and what the program, is it fixed, is it ARM, is it a 30, is it a 15-year term? Those are all things that you'll go over with your lender that'll give you those options and what those payments will be.
Hey, James, I have a quick question about what you just said with that mortgage insurance. So on the FHA loan, you're going to have that I think it's PMI. I forget what they're calling it now. I'm not even sure if that's the same lingo. But is there anything that I could do to still have an FHA loan and not have that?
No.
No. Okay.
Yeah. For FHA's MI is for life of the loan.
With a life.
When the 2008 crash happened, FHA raised its upfront fee, it raised its monthly fee, and it said MI now has to be paid through the life of the loan. So the only way to get out of paying that is to do a refinance into a conventional loan and drop that MI. Conventional still ends at 8. So, those are all things that the lender will take a look at with the borrower to see what's going to fit their needs best. One of the other things I would like to go into is credit scores. We, being in the business, we've all had borrowers call us to get pre-qualified, and they say, my credit score is 750. Where did you get that? I got it from Credit Karma.
Credit Karma.
So our job is to tell them that is not the score I'm going to get. Our scores tend to be lower than what the borrowers see on their on those websites, like through their credit card company or something like that. Or they'll say, I got it directly with TransUnion. Still a different score. So it's very important that the borrowers, one of the first steps they make is to get pre-qualified with the lender. And the reason for that is they're thinking they're someplace and they might be in a different place. And it's very crushing for a borrower sometimes when I finally convince them this, really need to take a look at your credit to do this pre-qual, and they finally get to that point. And on average, that score that they're looking at could be anywhere from 25 to 40 points lower or higher than what the mortgage credit report is going to be, which a lot of people don't know.
Question for you. Oh, sorry.
No, go ahead.
Question for you. So, if they are getting a FICO score, which FICO? Because I know Credit Karma does, I think Vantage score or something like that. But I do know some credit cards do a FICO score. So, and I know they have numbers and all that. So, what is the FICO score closer to what you get?
Not really, because the mortgage credit report's pulling in more information than any of those other reports are pulling in. So the only way you're really going to know is to have a mortgage credit report pulled. Now, there was a law passed, I think it was 2 or 3 years ago, which says you could have multiple mortgage credit reports in a 30-day period, and it only counts as one pull. Mm-hmm. So there's a lot of misconception out there. I'm like, well, no, if he goes to another lender and pulls it, my score is going to go down. No, that's not the case. It's still going to count as one pull, and it shouldn't affect your score. The other nice thing about doing a pre-qualification is even if you know your credit is not where you want it to be, with a mortgage credit report pull, we can run it through a system that tells us exactly what the client needs to do to improve their scores. So I can specifically say, pay down your credit card by $300 and your score will go up to this. And as long as they do what we tell them to do, the rescore takes 3 days, 35 days. Once we get the letter, they'll immediately see that improvement.
So we have someone who is, because we get this a lot with someone to say, oh, I'm not going to call the lender yet because I'm working on my credit. So it's better for us to say, go ahead and call the lender because he'll do rescoring for you.
Absolutely. The worst thing a borrower can do is try to fix it on their own. And the reason I say that is one of the big examples is a collection. Let's say you've had a collection on your credit report for 5 years. And you're like, oh, I'll just pay this off and it's going to boost my score. The borrower pays it off. You just hurt your score. You didn't improve it because that was an old account 5 years old. Now you've paid it and it's thrown that account up front to the system and said, here I am. So even though you've paid it, now there's been activity on it and it's considered recent. So in some cases on an FHA, you don't have to pay charge-offs, which a lot of people don't know. And you may not have to pay the collection depending on how much it is. So if you're trying to do that on your own, I can guarantee you that in most cases, you're just going to make a bad situation worse. You
So
need to
these
have a
credit,
lender.
I'm sorry. So these credit repair people are more so hurting than helping.
Sometimes they can. There's good ones out, just like any industry, there's good ones out there and there's bad ones. They make their money off of you staying on there for each month because you got to pay them a monthly fee to fix their credit. It is not to their advantage to do it quickly because they won't make as much money off the deal. So it's usually a slow and tedious process and something that could have been fixed by a lender telling them exactly what to do.
So what I want to point out is this, and this is what we always tell our buyers, and I want to make sure that we stress this. Although you look at your credit report and you may see things that are negative on collections or things of that nature, prior to making any decisions about what you think you can do to fix your credit report, you need to talk to the lender, because the lender, especially James and his programs, can make it so that they can look at your credit report and determine what needs to be paid. Because what could happen is that you pay something thinking you're helping your credit report and you're actually making it worse. So I definitely wanted to plug that in so that people do get that understanding, because that's something that we always stress when we deal with people. And I don't call it bad credit, I call it challenge credit, because it's about life. You know, certain things happen in life, you know, it's just a part of life. But what we try to do is, you know, a lot of times we try to fix things and then we make it worse than it could be. I do love the, you know, analogy about, you know, there's something that you're going to pay. It's minor. It's been on your credit report for 5 years. And now what you've done, you know, you've paid it, but now you have activated a whole bunch of other things, which, you know, I've seen people where, you know, they're 6 months and 6 years and 10 months. And they go, okay, I'm going to pay it. And so now what they've done is they've kind of messed it up where when they could have gone to the lender. And that's one of the reasons why we have these series with our lenders, so that you know, things that can help and things that can hurt. And I really want to talk about the credit scores that people will need approximately for the FHA and the conventional, and also the debt to income ratio, because a lot of people don't understand that.
Okay, the debt, everything nowadays is run through two underwriting systems. One is DU, desktop underwriting, and that is Fannie Mae's system. And then there is LP, Loan Prospect, which is is Freddie Mac's version of their underwriting system. So whenever you do a conventional loan, an FHA loan, or a VA loan, you have to run the borrower's file through those systems, and you have to get it approved eligible. Now with FHA and VA, you can do what's called manual underwrite. So if it won't go through, if you meet certain criteria for each agency, then the lender can go ahead and do a loan, which we've done. USDA is its own system. It's called GUS. So the lender has to run that file through GUS to make sure that it goes through. So regardless of the score, that has to happen. Those you have to follow those processes. Now, FHA really doesn't have a minimal credit score. It's what the market and the lender's willing to do. We go down to a 580. Some lenders will only go down to 640. Some will go to 620. Some might go below 580. But 580 is usually right around the industry standard of, you know, the minimal that they'll go to. VA, same situation. USDA, you have to have at least a 640 for USDA. And again, it has to go through GUS. So, but the goal of a lender is, if you come into my office and you have 580, and I know I can do it, you're going to get a much higher rate than someone would get at 640. So as a lender, the first thing I'm going to do is can I get this borrower from 580 to 640? That's the first thing I'm going to do. And it can be as simple as paying down a credit card $250 I've literally taken borrowers from 580 to 650 with paying down one credit card because it was almost maxed out. So, but some lenders won't do that. They'll just go with the 580 because they don't want to waste the time of working on it with the borrower to get their scores to that higher amount so they get a better interest rate and qualify for more house. Because the higher the interest rate, the less you qualify for. The lower the interest rate, the more house you can purchase, plus the better rate you get and the better terms. So those are the minimal scores. FHA, VA, 580, conventional, 620, and USDA, 640. So those are your minimal. Now, you're not going to get a great rate in MI on conventional at 620, and it may not go through the automated underwriting systems. So again, those are all the things the lender's doing behind the scenes. You shouldn't have to worry about it. We're just pointing you north and what you need to do, and you just concentrate on that. But okay.
Question for you.
Mhm.
Okay, so we're talking about the credit scores and how you can build the credit scores. Now, can you go a little bit about, there's 3 credit reporting agencies that credit scores are pulled. And for example, if I have a 700 in one, 400 in another, and a 600, and how do they determine what credit score they're going to use? Can we talk about that a little bit?
Yeah, it's basically they're going to use the middles of the 3 scores as their as a credit score. Fannie and Freddie, when they run the conventional side of it through DU or LP, now has a system where it averages the score. So it takes all 3 and just gives you an average. Sometimes that works in your favor, sometimes it doesn't. But the way it works is we'll take the middle of the 3 scores, and that's going to be the score that we use. Now, the FHA and VA and USDA are all going to go off the middle score too. They won't average it on their underwriting systems. The other thing too to remember is that when you're trying to work on your credit scores, the lender can give you other options. Example, one of the big things I've done in the past to help borrowers is maybe mom's got a credit card. It's an excellent payment history. She's had it for 5 years, low balance, never been late. You could have your mom add you on as an authorized user to that card, and you immediately get the benefits of that card towards your score. So, there's little things like that we can do. You can add your utilities, if you make them on time, to your credit report, and that will help boost your scores also. But those are all things that the lender needs to do to point you in the right direction to make sure you're not doing the wrong things and making the credit worse.
Oh. Okay, so can you tell us some of the programs that you have that can now assist our home buyers? I know you have certain programs that you can stack that helps to alleviate how much a buyer has to bring to closing. Can we talk a little bit about that?
Yeah. I've stacked as many as 5 down payment assistance programs on one loan. It was in Baltimore City. We just closed one last month that we stacked 2 programs on top of each other, and the borrower needed $1,200 to close. These are real situations. These are real stories. It is possible to get some of these programs. Again, it goes back to, I call it kind of interviewing. When you're looking for a lender, you're interviewing them. So normally you're going to take, get a referral from somebody as a good source or something like that. But you also need to ask questions of your lender. A lot of lenders don't want to mess with down payment assistance programs because they are time consuming. There's no getting around it. We have to do extra work. It's not we get paid anymore for it. It's just it's a benefit to our borrowers, so we do it on our end. But a lot of lenders don't want to do it because it's just extra work for them, and they don't want to do that. So when you interview with the loan officers, you want to ask them, is there any down payment assistance programs available? Sometimes they won't tell you about certain ones because they don't have it. The thing to remember is that when you're interviewing these lenders, you want to know, are they telling me everything? I will even mention down payment assistance programs to my borrowers that they don't qualify for, because I want them to know that I did look at that. I did check to see if they qualify for it, and this is why you don't. I want them to know that I looked at everything. Now, as far as the programs go, we're in a unique area for down payment assistance programs. DC's got three actually. HPAT now goes up to $200,000 on a second. You have the EHAP, which is for DC employees or contractors. That's another $2,500. You could stack them on both on top of each other, and you can get a DC Open Doors, which gives another 3% of the sales price. In Maryland, we've got a lot. Most of counties, like Prince George's has one. It's called Pathway to Purchase. Montgomery County's got one, 5 for 5. Frederick County has a down payment assistance. Howard County's got 5. Anne Arundel County's got one. Baltimore County, and the city's got several. And then we have our own state programs, which is Maryland Mortgage Program. You can get anywhere from 3, 4, or 5% of the sales price. I've got a borrower buying a house using the MMP, and she's getting $23,000 towards her down payment and closing costs. She needs $4,000 to get in, and if the seller can pick up the seller help side of it, she could theoretically walk in for nothing. We have our own program that we just came out with. It's $12,500 up to $12,500. So it's either 4% of the purchase price up to $12,500. We also have another program called the FHLB grant. That can be anywhere from $7,500 to $10,000. The $10,000 is for people that work for the school system, and I'm not talking just teachers. But I just had a bus driver that got the $10,000. I've had a cafeteria worker get $10,000. You just have to interact with students to get that. Then there's the medical side, nurses, but also patient intake people, because they deal with the patients. They get $10,000. Anyone that has interaction with the patients can get up to another 10. And then you have your police officers, your first responders, veterans. They can all get up to $10,000. So in that particular case, the borrower got $10,000. She was a teacher, and she got the $12,500. So it was a total of $22,500 she got in help. Plus, we're able to get some seller help, so she only needed $1,200 to get in.
Question for you. Also, we talked about some of the programs that we can stack in order to get buyer assistance. What I'm finding is sometimes buyers also don't understand that they have closing costs, and they also have loan cost. And so they kind of get confused over what's closing cost and what are the things that are associated with purchasing a loan. And if you could talk a little bit about that. And also, if we could talk about how when people are looking to get money, sometimes you have, oh, my aunt's going to give me some money. She's going to help me with this. About, the needing of the funds to be seasoned and also to be trackable should they decide to give gifts from other people to help with their home buying process or the down payment.
Okay, yeah, as far as gifts go, my advice is do not have any funds transferred over until you've been pre-qualified and have a contract and the lender can tell you exactly how to do it. The easiest way on conventional to limit the paperwork is to just have the donor wire the funds directly to the title company. Literally, all we need is a copy of the wire from the donor and a copy of the wire from the title company, and that's it in the gift letter. We don't need to get bank statements or any of that stuff. It's a lot easier. So, do not do a transfer of any gift funds until you've gotten a ratified contract and the lender tells you exactly what to do. FHA it's got to be a relative. We've got to document the donor had the funds in their bank account. We have to document that those funds were wired to the title company, and we have to document that the funds were received by the title company. So FHA, VA, USDA require more paperwork when it comes to gift funds. The conventional is the easiest. It's just a simple wire from the donor to the title company and 2 copies of the wires, and that's it. As far as down payment assistance goes, when you buy a house, you're going to pay your down payment and closing costs. I don't really know of any down payment assistance program that will not let the funds go to either one. So all the DPAs out there, those funds can either go towards down payment or closing costs or both. So it's not one particular side that it has to go towards. Now, each down payment assistance program has its own requirements, and those are things that the lender will go into detail with the borrower. Maybe you have to take, like, for example, in Baltimore City and County, you have to take the first-time homebuyer class first and do a one-on-one with a counselor before you can write a contract. If you write the contract beforehand, then you won't get any down payment assistance funds, except for the MMP. That's not the same for the others. The MMP, the PG, the Montgomery, the Howard. You can have a contract, then go through the process to get the down payment assistance fund. Some of those funds are handled by us, like our program we deal with ourselves. MMP we deal with, FHLB we deal with. So we get all the paperwork together and we submit it to them for their approval. The other thing I'd like to get into is everybody says down payment assistance. There's 2 different kinds. There's down payment assistance, which is based on a loan, and then there's down payment assistance, which is based on a grant. Those are 2 different things. Like example, MMP is a loan. So they'll give you, that $13,000, let's just say. But if you ever sell a house or refinance it, you have to pay that money back to them. Where our grant or our down payment assistance is a grant and FHLB is a grant. So if you use either one of those, it's forgiven after 5 years. So each year that goes by, a certain percentage of the amount that you owe goes down till it gets to 5 years, and then you owe nothing. You don't have to do anything. We remove the deed, the second deed from the loan, and you move on. So it's important to know what kind of down payment assistance you're getting also. You should ask, is this a loan or is this a grant? If it's a loan, it doesn't make it a bad thing, but you want to know, that up front so that when you go to refinance, it's going to be included in your payoff. You got to pay it back. Or if you sell it, you got to pay it back. Those are 2 different of the 2 different types of down payment assistance.
Also, can we talk a little bit about the pros and cons? For example, if you're a buyer that doesn't really need the down payment assistance programs, you have the ability to come to closing with your money that's necessary in comparison to having to get the down payment assistance. I'm really trying to focus more on some of the pros and cons with the interest rates. what interest rate would be higher, the programs or just the regular financing. So people understand that sometimes people just get the programs, but not understanding that there's a difference when it comes to the interest rates.
Yeah, as far as rates go, down payment on down payment assistance programs, the only real difference would be the MMP program through the state of Maryland. Their rates are higher than what the normal market rates are. Most of the other down payment assistance programs are going to be based off of normal interest rates. And what I mean by that is it would be the same rate you would get if you were bringing your own money to the table. Well, one thing to mention, though, what you brought up was the cash to close situation. Each down payment program has different guidelines for each one. That's another reason that a lot of lenders don't deal with it, because you have to remember all those. But like MMP has max income limit. They have a max loan amount or purchase price. They have, you have to be for these programs, you have to be a first-time home buyer or not have owned a house in 3 years. But MMP's got a program where if you just sold your house and don't own a house, you can use their down payment assistance money with this one program they have. FHLB has low income requirement. You have to have they have max income requirements for that program too. And they're, we've got to send the paperwork in, and they're the ones that calculate what that income is. So there's also a lot of these down payment assistance programs are for people who need the money. So if you have $100,000 in the bank and you want to get down payment assistance funds, a lot of those programs aren't going to give you the money because they're going to say you already have funds to close. Some don't care, but the majority of them do. If you've got the cash to close up to a certain amount, if you're over that, then they're not going to give you the down payment assistance funds because in their mind's eye, you've got the cash to close. But I mean, that's the main difference between the down payment assistance programs with that aren't grants, we'll call them loans, and the down payment assistance programs with grants. Most of the grant ones don't care. Like our program doesn't care how much you have in the bank. Doesn't care what you're putting down. I had a borrower that's putting down 20%, and they still got the $12,500. As long as they meet the requirement, the income requirement, and are a first-time home buyer, they can get those funds.
And I think it's really important that you did talk about the difference between the down payment assistance programs, because eventually our buyers will become sellers at some point. And sometimes what we run into as realtors when we're dealing with the seller end of it, and they're in these programs, their understanding of what program they were in, either they didn't quite understand it, or did not, probably was not provided the appropriate information. So they're finding themselves in a situation where they're trying to either refinance or possibly sell, and they're finding that some of those funds of what they're thinking they're going to receive at the table are really going to be, part of those funds are going to be eaten up because of the down assistance payment programs. So this is good for realtors to understand too, what kind of financing your buyers are approved for, so that we can also help to educate our buyers on these programs so that they make the right decisions and so that they understand exactly how they work. Because I think a lot of times the biggest misconception is that down payment assistance programs, I'm not going to say, we know it's not free money, but they think it's free money.
Yeah.
Do you understand?
Yeah.
So this breakdown is really important for those buyers to really understand, and to really kind of ask questions. So this was great. I appreciate you breaking that down.
Yeah.
I'm sorry, go ahead.
Yeah, just to add to that, I mean, that if you're a borrower and you're going to sell your house, that that's why it's important to use the right realtor, because when they come in and you're calculating how much they could sell the house for, one of those questions should be, when you bought that house, did you have any down payment assistance funds? That should, because if not, 13,000 is a big, that can swing things pretty quickly on a tight transaction. So
yeah. So this is a great conversation to also have with our potential sellers.
And also, because normally what we do is, when we do go on appointments, we do talk to people and we ask them, how much do they owe? And we actually ask them that's one of the reasons why we ask them to contact their bank, because sometimes if they get a statement is different from what the bank. And what we do as a team is we also, although title does a search, we will also research the property too, to see if there's any liens that are within the system. Because, I had one recently where I'm come to find out there was a silent second lien on the property, and the people had no clue. And unfortunately, not the funny part, but they found out just in time that they had almost $70,000 that was going to become due, payable in full within the next couple of years. And they had no clue about that.
Yeah, and there was two other programs that I wanted to mention too. I forgot to. One is called the Smart Buy. That's through MMP. It's a good one for students. Like if you have $50,000 in student loan debt or less, and you've already graduated, they'll pay that off through the MMP and give you down payment assistance towards the purchase of a new house. So that's a program that is pretty popular amongst the younger crowd, students who might have gone to community colleges and stuff like that, and technical places. So because 50,000 is in today's world is not a lot, but it would be for someone who might have been in college and they just maybe their parents cover some of it but not all of it. And there's another program that we have which is 100% financing. It's our medical professional program, but it's very broad. So it'll go up to $750,000, no mortgage insurance, 100% financing, and you can be a nurse practitioner, a new doctor, orthodontist, dentist, chiropractor. There's a list of like 15 different medical titles that would qualify for that program. It's really good. The rate's pretty good. And it has a 30-year fixed option on it too. But the nice part is it's 100% financing, but also it's no mortgage insurance. So that's a good program too.
Fantastic.
Well, we're coming up on, probably have maybe 7 minutes left. I want to really thank you, James, for coming up to share the wealth of information. I'd also like you to give your contact information should people have additional questions that they may want to talk to you about. We talked about the student loans, we talked about different mortgage programs, we talked about home buyer assistance. So you've given us a wealth of information that we can share out to our family of potential home buyers. But also, if you just give your information so someone wants to reach out directly to you, we'd appreciate that also.
Yeah, thanks, Janell. The cell phone number is 301-717-6272, and my email is james.adamson, ADAMSON, at amerisbank.com. That's AMERIS bank.com.
The great thing about it is that this has been recorded. It will also be on our Facebook page. It'll be on our YouTube channels. So if you missed it, or if you just need to, have to go back and want to review some information that was given to you, we meet every second Saturday of the month. We look forward to showcasing our partners that we deal with to bring you some exciting information that can help with your home buying and home selling process. We just don't deal with first-time home buyers. We deal with second-time home buyers, third-time home buyers. We deal with our home sellers. So I'm Janell McIlwain with Samson Properties, team leader of the McIlwain Group. We have Dawn Ferguson. She's a real estate agent with our team. Tia Thompson. If you see, Jackson has also come. So we want to thank you for meeting with us. As we say, we try to keep this for an hour. Hope you have a wonderful day and enjoy the rest of your Saturday.
Thank you, James. Thank you,
Thanks,
guys.
James.
I'll see you.